What if the greatest fortunes in history were built not by creating wealth, but by quietly collecting interest while nations collapsed under their own weight? It sounds impossible, almost absurd. Yet the deeper you dig into global economic history, the clearer a disturbing pattern becomes. Every empire, every modern state, every financial system that spiraled into crisis left behind a trail of winners. And those winners were rarely the governments, the workers, or the institutions the public trusted. They were families whose names almost never appear in textbooks, families that mastered one principle long before the rest of the world understood its power. Wealth created through production is fragile. Wealth created through interest is eternal. To understand how this paradox took shape, imagine the moment when kings, parliaments, and later entire nations discovered that they could spend money they did not yet possess. Debt transformed from a temporary tool into a permanent lifeline, and the people who provided that lifeline quickly realized something revolutionary. If the principal was never repaid, if loans were rolled over indefinitely, if interest kept flowing year after year, then they were no longer lenders. They were partners in the machinery of state power, and as the world lurched from war to reconstruction, from crisis to expansion, these families learned to position themselves in the one place where risk evaporated and reward multiplied. Not at the center of the fight, but just behind it, silently financing both sides of history. Across Europe, across the Americas, across the colonies woven into the emerging global economy, governments grew dependent on this arrangement. They borrowed to build navies, borrowed to suppress revolts, borrowed to industrialize, borrowed simply to survive one more fiscal year. And every payment they made, every tax collected from citizens struggling under economic strain, flowed upward into private ledgers that accumulated. Wealth on a scale the average person could not imagine. The most remarkable part is that none of this required manipulation in the shadows. The system itself, once set in motion, rewarded those who understood it and punished those who didn't. It became the quiet engine of inequality, the invisible script guiding financial history. And as you start to see how this mechanism took shape, you may begin to recognize echoes of it in the world around you. Have you ever wondered why crises seem to devastate millions while enriching a few? Or why some institutions remain untouchable even when everything else burns around them? Understanding this story is not just about economics, it is about seeing the architecture of power with new eyes. If any part of this resonates with you, share your thoughts in the comments, leave a like to support this kind of deep investigation, and make sure you are subscribed so you do not miss what unfolds next, because what comes after this foundation will take the entire picture to a much more unsettling level. The moment you grasp that interest, not production, became the engine of lasting power, another question emerges almost immediately. How did this system begin in the first place? And why were so few people able to see its long-term implications? To uncover the origins of perpetual debt, you have to go back to the era when governments first realized that traditional revenue streams could no longer sustain their ambitions. Wars became more complex, infrastructure demanded larger investments, and empires stretched themselves across continents, burning resources faster than taxes could replenish. This mismatch between ambition and funding created a new opportunity, one that would quietly reshape global economics in ways no ruler fully understood at the time. When sovereign borrowing became normalized, the families capable of providing large-scale credit stepped into a role that blurred the line between advisor, rescuer, and silent, architect of national destiny. The earliest versions of these arrangements were straightforward on paper, yet revolutionary in practice. A monarch would request funds, often in desperation to defend territory or maintain political stability. In return, lenders received privileged access to trade routes, mining operations, or long-term repayment schedules that effectively made them partners in the state's economic future. What seemed like temporary alliances soon became structural dependencies. Once a kingdom learned to operate on borrowed money, stepping away from that model became nearly impossible. Every new crisis demanded another loan. Every loan invited new terms. And with each negotiation, these families tightened their position, not through coercion, but through the natural leverage created by the state's growing reliance on external capital. This shift also introduced something far more transformative than the rulers expected. Debt stopped being a financial obligation and became a political instrument. Nations that borrowed heavily were forced to shape their decisions around the expectations of their creditors, even if those expectations were never formally stated. The influence worked indirectly but powerfully, guiding economic strategies, foreign policies, and in some cases, the very survival of the regime. And because the public rarely understood how these mechanisms operated, the true scale of this influence remained invisible. People saw rising taxes, sudden austerity, or shifts in national priorities, but they rarely connected these changes to the steady, compounding pressure of interest payments flowing upward to private dynasties that had learned to turn liquidity into leverage. What makes this origin story even more intriguing is how familiar it feels when viewed from the present. The patterns first established centuries ago still echo through modern financial systems. Governments borrowing to delay the consequences of political decisions, institutions expanding their power by supplying credit at strategic moments, and entire generations living under fiscal structures designed long before they were born. By tracing the beginnings of this cycle, you begin to see not just how it started, but why it has proven so durable and how it prepared the stage for the families who would later transform borrowing from a necessity into a global framework of influence that operates quietly behind every major economic shift. As the foundations of sovereign borrowing solidified, a new dynamic began to unfold, one that would elevate certain families from influential lenders to architects of global finance. These were not ordinary merchants or opportunistic investors. They were lineages that understood something deeper about the way power moved through economies. While monarchs focused on territory and armies, these families focused on information, liquidity, and timing. They realized that the real advantage was not merely providing loans, but positioning themselves at the crossroads where political uncertainty met financial desperation. Their networks expanded across borders, forming webs of correspondence, trade partnerships, and discrete alliances that allowed them to see crises before they fully formed. This early access to knowledge became a force multiplier, turning every geopolitical disturbance into an opportunity to reinforce their strategic position. One of the most revealing aspects of their rise was the way they blended patience with precision. Unlike rulers chasing short-term victories, these families operated with a mindset anchored in long arcs of history. They recognized that lending to a state was more than a transaction. It was an investment in the future behavior of that government. A nation in debt behaves predictably. It prioritizes stability over innovation, continuity over disruption, and access to capital over ideological purity. This predictability allowed these families to forecast political and economic movements with uncanny accuracy, not because they controlled events directly, but because they understood the structural constraints imposed by debt obligations. They learned to think in cycles, anticipating downturns, recoveries, conflicts, and transitions long before public institutions could react. As their reputation for reliability grew, so did their influence. Governments started to treat them not simply as lenders, but as indispensable advisors whose financial insight could determine the success or failure of national strategies. During moments of crisis, rulers often found themselves turning to these families before consulting their own ministries. This created a subtle but powerful shift in the balance of authority. Paper agreements, interest schedules, and credit lines quietly shaped decisions that seemed on the surface to be driven by ideology or national identity. The public saw kings, presidents, and parliaments making choices, but behind those choices were spreadsheets of obligations, repayment timetables, and the silent understanding that the stability of the state depended on maintaining relationships with those who held its debt. What makes this evolution so striking is how seamlessly it unfolded. There were no dramatic takeovers, no explicit claims to political power, no proclamations of dominance. Instead, influence accumulated the way interest does, gradually, invisibly, and relentlessly. By the time most governments realized how much leverage these families possessed, the financial system had already been built around their participation. Removing them would have triggered instability. Relying on them promised continuity. And through this delicate balance, they created a model of wealth and authority that transcended borders, monarchies, and ideologies, preparing the ground for even more sophisticated forms of financial influence that would emerge in the centuries that followed. As these families expanded their reach, a new era emerged, defined not by open conquest or dramatic political upheavals, but by subtle manipulations that unfolded beneath the surface of global events. The 19th and early 20th centuries became fertile ground for this evolution, a period where nations industrialized rapidly and financial markets matured into complex ecosystems. What appeared to be natural cycles of boom and bust often carried fingerprints that were anything but accidental. Crises rarely erupted in isolation. They tended to follow patterns that repeated with eerie precision. Liquidity tightened, markets panicked, governments scrambled for emergency funds, and those positioned to offer relief did so at terms that further tightened their long-term influence. These episodes were not orchestrated outright, but they were anticipated and leveraged with remarkable skill, turning instability into a catalyst for deeper financial entanglement. As wars erupted, borders shifted, and economies expanded beyond anything the world had ever seen. The silent advantage held by these families grew exponentially. Major conflicts, while devastating for populations, created unprecedented opportunities for financing military campaigns, reconstruction efforts, and the rebirth of entire industries. Every upheaval required capital, capital concentrated in private hands, had the freedom to move quickly and with far fewer constraints than state-controlled resources. This agility allowed certain families to play both sides of history without ever stepping onto the battlefield. Their influence increased not because they controlled governments directly, but because governments repeatedly turned to them at their most vulnerable moments. Dependence hardened into structure, and structure became tradition, accepted without question by generations who inherited systems already shaped by this hidden continuity. Perhaps the most revealing aspect of this period is how thoroughly the public narratives of nations diverged from the financial realities guiding them. Governments spoke of patriotism, progress, and democratic will, while behind closed doors they negotiated the terms of survival with individuals whose interests transcended borders. Those negotiations rarely appeared in historical records or classroom textbooks, yet they left traces in policy decisions, currency standards, and international agreements that still influence modern economies. What seemed like the natural evolution of global finance was, in many cases, the cumulative effect of choices made under pressure, choices that quietly transferred influence away from public institutions and toward private dynasties that understood how to turn crisis into opportunity. If you have ever sensed that some turning points in history carried a hidden symmetry, or that certain outcomes seemed strangely predictable despite the chaos surrounding them, share your thoughts in the comments below, especially if any specific moment or crisis came to mind. As financial systems evolved, a turning point emerged that would redefine the relationship between lenders, governments, and the global economy, the moment debt itself became a product. Until then, borrowing had been a tool, a necessity for states facing war, expansion, or fiscal shortfalls. But as markets matured and financial innovation accelerated, something quietly transformational occurred. Institutions learned to package, trade, resell, insure, and leverage debt in ways that multiplied its value without ever touching physical assets. This shift unlocked a new dimension of power, allowing those who understood the mechanics to profit not only from interest, but from the movement of the debt itself. The families and institutions already positioned at the center of global finance recognized immediately how revolutionary this was. Controlling resources was no longer necessary. Controlling the terms of borrowing became far more profitable. The rise of bonds, derivatives, and structured financial instruments amplified this transformation. Governments that once negotiated directly with lenders now faced entire markets that could determine their fate through shifts in sentiment, yield demands, and speculative waves. Risk became a commodity, and those capable of predicting its fluctuations gained leverage that dwarfed the influence once held by early financiers. What made this even more striking was how seamlessly the transition unfolded. Debt turned into a globally traded entity, with prices fluctuating not on the basis of tangible goods, but on the perception of stability, future earnings, and geopolitical behavior. Families and financial dynasties who had mastered long-term cycles found themselves in a position of unprecedented advantage. They did not merely lend, they shaped expectations, guided markets, and positioned themselves ahead of every major transition. As markets embraced these new instruments, the distance between financial power and everyday reality widened dramatically. Nations struggled with budget pressures, citizens faced rising taxes, and public institutions grappled with austerity, while at the same time wealth flowed more efficiently to those who understood how to navigate the expanding world of financialized debt. Decisions, once grounded in political ideology, became increasingly influenced by market reactions. A sudden spike in yields could topple a government. A downgrade could alter a nation's development for decades. The most sophisticated players did not need to manipulate these events directly. They only needed to anticipate the movements created by fear, uncertainty, or speculative enthusiasm. By the time the public realized how deeply their lives were tied to financial markets, the system had already matured beyond any single nation's ability to control. Seen from this angle, the evolution of debt into a product was not simply an advancement in financial engineering. It was the moment when the logic of markets began to dominate the logic of governance. And as this new paradigm took hold, the families who had been accumulating influence for centuries discovered that they could now operate on a global scale, moving capital across borders with ease, shaping liquidity conditions, and positioning themselves at the center of nearly every economic shift that followed. The deeper you look into the evolution of financial power, the harder it becomes to ignore a fundamental contradiction at the heart of modern economies. While debt became a lucrative engine of wealth for a tiny minority, it also became an invisible burden crushing the lives of millions. As governments embraced financialization and markets rewarded those who understood how to manipulate the velocity of capital, ordinary people found themselves increasingly trapped inside systems designed without their well-being in mind. The cost of living rose faster than wages. Credit became a necessity rather than a choice. And austerity measures imposed to stabilize national budgets fell squarely on the shoulders of workers who had no voice in the negotiations that created the crisis in the first place. A mechanism that had once been a tool of statecraft evolved into a structure that extracted value from society with mathematical precision. What makes this particularly striking is how seamlessly the human consequences were hidden behind technical language. Terms like fiscal tightening, structural adjustment, and debt sustainability became shields that obscured the lived reality of the populations affected. Entire communities absorbed the impact of rising interest payments that funneled national resources into the financial sector instead of public services. Hospitals deteriorated, schools faced chronic shortages, and infrastructure decayed, while budgets were reoriented toward honoring obligations to creditors. Families already grappling with instability were pushed further into precarity, forced to rely on personal debt to offset cuts in social programs. The very instruments that enriched financial elites amplified the vulnerability of those who had no stake in global markets beyond the involuntary role of taxpayers keeping the system afloat. In many countries, this dynamic reshaped the social fabric itself. Migration surged as people sought opportunities beyond the borders of economies, strangled by external obligations. Political tensions deepened, driven by frustration with governments perceived as serving distant financial interests rather than local needs. Protests erupted, not just in developing nations, but in wealthy ones as well, revealing that even advanced economies were not immune to the pressure of compounding obligations. Every cycle of crisis exposed the widening gap between those who could navigate financial turbulence and those who simply endured it. And yet, despite the scale of the suffering, the system continued to reinforce itself, creating conditions where the cost of change appeared riskier than the slow erosion of stability. The irony is that the individuals and families who benefited most from the system rarely appeared on public stages or in political debates. Their influence operated through institutions, markets, and advisory networks rather than direct confrontation. They did not dictate policy openly, but their expectations shaped the boundaries within which governments could act. As markets grew more interconnected and the flow of capital accelerated, the distance between financial power and democratic accountability widened even further. This created a world where the wealth extracted from rising debt obligations became increasingly concentrated, while the burden of maintaining the system expanded across entire populations who never chose to participate in the first place. As global finance entered the late 20th and early 21st centuries, the mechanisms behind debt accumulation became increasingly complex, yet the underlying architecture remained surprisingly familiar. What changed was not the logic of the system, but its scale and invisibility. Institutions that once operated quietly behind the scenes evolved into multinational entities with influence spanning continents, and the families who had positioned themselves strategically generations earlier now navigated this expanded landscape with unparalleled sophistication. Instead of relying solely on national governments, they built relationships with international organizations, central banks, and investment networks that collectively shaped the economic trajectory of entire regions. Their power no longer depended on any single state. It flowed through the arteries of the global financial system itself. At the center of this transformation was a set of tools designed to maintain the perpetual motion of debt. Credit rating agencies began to determine the cost of borrowing for nations, effectively rewarding or punishing governments based on opaque criteria that mirrored the interests of global capital. International lenders imposed structural reforms that forced countries into fiscal frameworks aligned with creditor expectations, often at the expense of social stability. Financial institutions engineered products capable of amplifying gains during expansions and magnifying losses during downturns, ensuring that volatility itself became a lucrative opportunity. Through these mechanisms, influence became both dispersed and concentrated, dispersed across a network of organizations, yet concentrated among those who understood how to interpret and profit from the system's design. What makes this era remarkable is the degree to which these processes operated without public scrutiny. For most people, the system seemed too abstract, too technical, too entrenched in specialized language to question, yet beneath the layers of complexity, the pattern remained the same. Nations borrowed to sustain political promises, investors calculated risk with increasing precision, and the gap between financial power and democratic oversight widened steadily. Decisions framed as economic necessities often reflected the priorities of those who had the most to gain from maintaining the circulation of debt. And as crises erupted at regular intervals, each one served as an inflection point that strengthened the influence of the same actors who emerged from previous upheavals with greater leverage than before. If any part of this hidden machinery of global debt resonates with your own observations or experiences, share your thoughts in the comments below, especially if you have ever sensed that some institutions wield far more influence than they publicly claim. The arrival of large-scale digital finance marked a dramatic acceleration in the evolution of debt-based power. What had once required physical ledgers, personal negotiations, and slow cross-border communication could now unfold in milliseconds. Algorithms replaced clerks, automated trading replaced human instinct, and liquidity moved with a speed that redefined both opportunity and vulnerability. For the families and institutions already positioned at the top of the financial hierarchy, the digital revolution offered an unprecedented advantage. They could analyze vast quantities of data, detect patterns invisible to ordinary investors, and deploy capital with surgical precision. Markets became less about intuition and more about information asymmetry, and those who controlled the flow of information quietly expanded their influence over global debt cycles. This transformation also altered the psychology of entire nations. Governments that once viewed borrowing as a deliberate political decision began to treat it as a routine financial mechanism, encouraged by digital platforms that made capital appear limitless and risk appear manageable. Sovereign bonds circulated through global networks where investors could buy or sell millions with a single click, often without any understanding of the domestic implications their decisions would trigger. Volatility became a constant presence, driven as much by automated reactions as by human strategy. The speed of digital markets compressed the timeline of crises, turning what once unfolded over months into events that could destabilize economies within hours. This new environment rewarded preparedness and punished hesitation, giving an even greater edge to those who had mastered long-term positioning. At the social level, the shift to digital finance introduced new forms of inequality. While consumers were encouraged to adopt digital banking, mobile credit, and online loans, the sophistication of the tools used at the top of the system expanded far faster than the financial literacy of the general population. Ordinary individuals interacted with debt through user-friendly interfaces that concealed the complexity behind interest rates, algorithms, and risk models. Meanwhile, institutions leveraged the same digital infrastructure to automate returns, diversify risk, and react instantly to geopolitical shifts. The result was a widening gap between how the public experienced debt and how elites exploited it. One side saw convenience, the other saw leverage. What makes this period especially significant is how seamlessly digital finance integrated itself into the existing structures of global power. Instead of replacing traditional systems, it amplified them. Families and institutions that had long profited from debt cycles found new ways to refine their strategies, using technology not to change the game, but to accelerate its pace. Debt became more liquid, more dynamic, and more deeply embedded in daily life, making the system harder to observe and even harder to challenge. And as digital platforms expanded their reach, the stage was set for an era where economic influence operated at velocities and scales previous generations could not have imagined. As digital systems reshaped the speed and structure of finance, another transformation unfolded quietly in the background: the consolidation of global influence into an interconnected web of institutions, funds, advisory bodies, and financial dynasties that collectively shaped the modern world far more than most citizens realized. This new landscape was not defined by territorial empires or military dominance, but by the architecture of capital flows. Nations that once projected power through conquest now found their strength measured in creditworthiness, liquidity reserves, and the confidence of investors whose identities often remained obscure. The families and institutions that had understood the logic of debt for centuries adapted effortlessly to this new reality, cultivating relationships with central banks, sovereign wealth funds, multinational corporations, and regulatory bodies that governed the financial order from behind polished conference tables. In this environment, influence operated less like a hierarchy and more like a network. A decision made in one financial hub could alter bond yields on another continent within minutes. A shift in monetary policy could trigger capital movement across dozens of markets before most citizens even heard the announcement. The actors who navigated the system successfully were those who understood the interconnected nature of global finance, recognizing that modern power did not lie in controlling any single institution, but in anticipating how institutions influenced each other. This predictive advantage created opportunities invisible to the untrained eye. When a central bank signaled tightening when an emerging market faced political unrest, when commodity prices dipped or surged, strategic players could adjust their positions long before governments or the public grasped the implications. The globalization of influence also redefined the boundaries of accountability. Decisions that shaped the financial fate of millions were often made by committees, boards, and advisory groups whose proceedings were not public and whose members operated with minimal scrutiny. Yet the effects of those decisions rippled into the daily lives of people far removed from the rooms where they were crafted. A liquidity injection could inflate asset bubbles that widened inequality. A regulatory tweak could alter the flow of investment into developing countries, determining which regions prospered and which sank into stagnation. And through all of this, the families and institutions that mastered long-term positioning remained sheltered from the volatility experienced by the broader population. They could weather downturns, hedge risks, and capitalize on uncertainty, while workers and small businesses faced the consequences with far fewer tools at their disposal. What makes this stage of global finance especially revealing is how effortlessly it masks itself as natural, inevitable, or purely technical. The language of markets encourages the belief that forces like risk, confidence, and valuation operate independently of human intention. But behind every shift in sentiment, every adjustment in liquidity, every fluctuation in currency value, there are strategic interests interpreting the global landscape through lenses shaped by generations of accumulated knowledge. And as the gap between those who understand this system and those who merely endure it continues to widen, the influence of these networks becomes not just an economic force, but a defining feature of the modern world's political and social trajectory. As the architecture of global finance grew more intricate and interconnected, the final element of this long historical arc came into focus: the realization that debt is not merely a financial mechanism, but a framework that shapes the future of nations and the distribution of power across generations. When obligations compound faster than economies grow, the balance between autonomy and dependency tilts steadily toward those who hold the keys to liquidity. Governments confronted with rising interest payments face difficult choices, often sacrificing long-term development for short-term stability. Meanwhile, the institutions and families that mastered the cycles of borrowing and repayment position themselves to thrive even when the broader system falters. Their strategies are not anchored in ideology or national loyalty, but in the enduring logic of capital, which seeks resilience, leverage, and continuity above all else. What makes this moment especially significant is the convergence of old mechanisms with new vulnerabilities. Digital finance accelerates the spread of crises. Geopolitical tensions amplify market uncertainty. Demographic shifts strain social systems already burdened by decades of compounding obligations. In this environment, the advantages held by elite financial actors become even more pronounced. They do not need to predict every crisis with perfect accuracy. They only need to understand the structural pressures that make crises inevitable. When liquidity tightens, when central banks hesitate, when markets wobble, they are already positioned to convert volatility into opportunity. Their resilience is not a coincidence, but the outcome of a centuries-long refinement of strategies rooted in the predictable behavior of indebted states. But at the same time, ordinary citizens feel the consequences of this structure more directly than ever. Rising interest rates ripple through housing markets. Currency fluctuations reshape the cost of basic goods. Budget cuts driven by debt obligations reduce access to essential services. And while these burdens accumulate, the system itself continues to reinforce the imbalances that produced them. The gap between those who benefit from financial turbulence and those who suffer from it expands with every cycle. Yet the resilience of this system also reveals something important. It is not immutable. Systems built by human decisions can be reshaped by human understanding, and recognizing the patterns that guide global finance is the first step toward interpreting the forces that influence modern life far beyond the realm of economics. If you reach this point, you already see how deeply these cycles shape the world we live in, and your perspective matters here. And leave a comment saying this message was for me, so I know you stayed with me until the end. If the journey through these hidden financial structures resonated with you, consider subscribing so you do not miss the next chapter, and leave a like to support this kind of long-form investigation. There is a video right here that continues this line of thought in a way that deepens everything we uncovered today. So click and keep exploring with me as the larger picture becomes even clearer.